Now, while the Dow just touched its highest level in nearly 3 weeks today, it's still on track for its worst month since January. The S&P and Nasdaq are having their worst month since last October, and Morgan Stanley is warning that anyone buying into last week's rally is in for trouble, saying valuations are too frothy, the global supply chain is a mess, the government is on a crash course with a shutdown, and Fed tapering is just around the corner. Does my next guest agree? Joining me now is David Bahnsen. He is Chief Investment Officer at the Bahnsen Group. Are you more sanguine, David, or how do you think things are shaping up here?
Well, it depends on the timeline they're talking about. Mike Wilson, who wrote that report, I worked with him at Morgan Stanley, and he tends to lean negative quite a bit. I think he's made a similar call to this about 15 times lately. And like all people, pointing out pretty logical things that don't look good all the time in the markets have had an opinion of their own. And so I wouldn't make any short-term decisions around that report from Morgan Stanley. I hopefully don't have clients that are making short-term decisions at all, though. You know, we want to be able to have a little longer-term view. And so that's where the sanguine comes from, is that we do believe through time the way that particularly our dividend orientation is positioned will do quite well. But as far as the markets needing an excuse to have a correction or some downside volatility, there's plenty of excuses out there to choose from.
There's a ton of investors, David, breathing a huge sigh of relief to see financials and energy back in the leadership. You know, people who were overpositioned, looking for rates to finally move to the upside and so forth. Is this really sustainable, though? And should the trades remain married? I mean, on the energy side, I see that Chevron is one of your picks, but I just have to wonder how high oil prices can remain, how much higher they can keep going. You know, maybe we've got a few more months of this ahead of ourselves, but if we start going back to 100 or over a barrel, I have to imagine there's going to be long-term demand destruction. There's going to be screaming from policymakers, expanded supply. You know, why is Chevron a name you want to bet on for the long run?
Well, our thesis on Chevron has absolutely nothing to do with the price of oil. And so there's sort of two different questions there. I agree with you completely. Oil prices getting near $100 are not good for the energy sector. It drives a lot of margin for the short period of time. But as you exactly pointed out, long-term demand destruction is a real phenomenon. There is sort of a sweet spot in this supply-demand crux. I suspect it's between 60 and 80. We're at the upper end of that range now, back above 75. Chevron makes an awful lot of money at $60 oil. So the price of the commodity is not the thesis. It's that the valuation of the company is extremely low relative to its normalized free cash flow. And Chevron is a 5.5% dividend payer in a weak part of the market. We think has plenty of road ahead. But you also have to remember the natural gas story and the downstream story. These are integrated companies. Chevron has a lot of ways they can make money regardless of the oil price.